I think is the last House Insurance and Pension meeting. So, anyway, yeah. Anyway, so is that when you throw the insults like they did on the Tonight Show years ago? Anyway, but would welcome Representative Schmidt, Representative Hoy, and Representative Kelly to the committee for this meeting. So appreciate that. Today we'll go through Senate Bill 450. And should the committee be ready to work that, which I would request that you would think of that as we're hearing that. Senate Bill 523 is similar to another bill, but I thought it was useful to hear the Senate's position on that topic. And then we will go back to work Senate Bill 377 and to have a discussion on two bills that we had heard earlier that are blessed, 2593 and 2639, 377 related to the captive for the technology-enabled financial fiduciary institutions, and 2593 and 2639 related to working after retirement. I know there was some question in what had happened on Senate Bill 28 and how that had occurred. I had asked questions also, and when I reviewed the video at the 1 hour 22 minute mark, the motion that was made began with the statement pass out. There was a clarification to make sure that we had carved out everything that was in that Senate bill to replace it. That motion did pass. We have received the committee report, and that is continuing in process. I believe it was clear and did confer with the reviser and the chief reviser to make sure that that was consistent in our interpretation with how that process had gone. Should anyone have any questions on that, please do direct those to me. With that, we will start with Senate Bill 450 and ask the reviser for an overview.
Good afternoon, Mr. Chair. Thank you, members of the committee. This is substitute for Senate Bill 450. It's eliminating the crediting to the Kansas Public Employees Retirement Fund of 80% of the proceeds from the sale of surplus real estate. It authorizes state educational institutions to sell and convey real property given to such state educational institutions as an endowment, bequest, or gift, and it authorizes the State Board of Regents to adopt policies relating to such sales and conveyance. So as originally drafted, Senate Bill 450 amended KSA 75-6609, and it authorized state educational institutions to sell and convey real property given to such state educational institutions as an endowment, bequest, or gift. And as I said, it authorized the State Board of Regents to adopt policies relating to such sales and conveyances. As originally drafted, Senate Bill 322 ended the crediting to capers of the 80% of the proceeds from the sale of surplus real estate. The Senate Committee on Financial Institutions and Insurance heard both bills and combined the two by adding the contents of 322 into 450 as both bills amended the same statute. On February 23rd of this year, the Senate Committee of the Whole passed substitute for Senate Bill 450 on a vote, not a boat, the boat left already, on a vote of 38-2. So if you look at the bill, Section 1 of the bill would create a new provision of law that would grant the State Board of Regents authority to authorize a state educational institution the ability to sell and convey real property that was given to such a state educational institution as an endowment, bequest, or gift. The bill would also grant the State Board of Regents the authority to adopt policies governing the procedures and conditions under which a state educational institution may sell and convey real property that was given to that state educational institution as an endowment, bequest, or gift. Further, new Section 1 would also require the State Board of Regents to submit to the Legislature a list of any real property transfers that occurred during the previous fiscal year. Pardon me, I've got butterfingers. And it would also exempt the sale and conveyance of real property given as an endowment, bequest, or gift to a state educational association institution from the provisions of KSA 75-6609, which specify the processes and requirements that the Department of Administration follows in identifying surplus real estate for sale, and from the provision requiring that 20% of the proceeds be deposited into the state treasury and credited to the surplus real estate fund. On page 4 of the bill, in lines 5 through 7, you'll see that amendment, and it's being amended to state that the sale and conveyance of real estate given as an endowment, bequest, or gift would be subject to the provisions of new section 1 that I just described. The amendment that ends the crediting to KPERS of 80% of the proceeds from the sale of surplus real estate appears on page 3 of the bill in subsection F1. The bill would become effective upon its publication in statute book. And with that, Mr. Chair, I can stand for questions.
Committee questions, Representative Riley.
Thank you, Mr. Chair. When I was going through and trying to research this, I had some questions, and I would be open to the chair commenting on this, or Eileen, if you know information. But it seems like at this point, we're completely reversing some thinking that we did 10 years ago for some reason. And so I pulled up the bill, that part of the statute, and so I see two sections of that actual statute where it was actually changed, I think in 2018, where two pieces of property were made not subject to the provisions of the section kind of thing. They were pulled out. So I guess my question, maybe this is a research question, how many actual properties ever were sold that actually put funds into KPERS? Do anybody that has history or a representative that has history of this bill can help me out on this? Thank you.
And it's possible that our neutral testimony can provide some information on that, but any history that the revisor has is welcome as well.
Mr. Chair, I am old, but I do not have that history. Sorry.
So thank you. Any further questions on that?
Mr. Chair, I'm sorry.
Melissa.
Mr. Chairman, you are correct. KPERS will speak to it as well. The information provided in the Senate hearing is also in the supplemental note. And since 2012, when the provision was changed from the surplus going to the State General Fund to KPERS for the support of the unfunded actuarial liability, we were told that those proceeds have transferred to the trust fund a total of $1.9 million. And as I recall, one of the largest projects was the insurance department in the Dillon House. But we also learned that several Regents institutions projects have been exempted from the statute, which we had also learned in the Joint Committee.
So thank you. Representative Riley.
Thank you. Was that 1.9, was that one piece of property that sold and that was 80%, or was that two or three pieces? Do we have any idea how much that is?
So, and we can wait for neutral testimony on that.
Again, I'm open to, anybody that has history of why we did this. I know that we were way underwater in 2012. And so there was good reason at that point to do this. So here we are 10 years later, we have all kinds of money, and we're changing our thinking. So I just would like to know what's going on.
So thank you. Melissa?
Mr. Chairman, committee members, if you would look ahead to the testimony that Mr. Conroy has presented on Senate Bill 450, the second page, you will see a list of those projects that were between fiscal year 2014 and fiscal year 2021. And as you'll see, the Dillon House was one of the larger projects, but not the only sale of surplus state property.
Thank you, Mr. Chair.
So thank you. Representative Dodson.
Thanks, Mr. Chair. My question is similar to Representative Riley in that I was interested in the rationale for why the state would take some of the money from a sale from one of their institutions to themselves rather than allowing it to be returned in the first place. So as I understand the discussion, it was because of shortages in the fund. Is that right?
I am going to let the conferee speak to that question. The policy for these bills that I draft are really not something that the revisor's office get into. We get a bill request, we, determine what the goal is, and we draft the bill. So policy is not something that is driven by our office.
Thank you. Thanks, Mr. Chair.
So, and just to make sure that I'm caught up, 450 started with a law that would set up that the regions would adopt the policies and governing procedures for the sale or conveyance of property given as an endowment, bequest, or gift. So that was the initial topic. Then to that, we added this amendment, amendment for the Capers sale. So we are accomplishing those two things then in the bill.
That's correct. Both bills amended the same statute, so it made sense to put the two bills together into one.
Great, thank you. And then under some of our proponent testimony, we may get some detail on what that first part of the bill would look like. So thank you. Further questions, committee? Representative Riley.
I think my question then is, just from the information that we have here, and maybe we'll get this answered, but so being in another committee where we know about some projects that some of the colleges are selling property this year, and that bill is moving through. So when they sell that property, the way it looks right now, instead of any of that money going into Capers, they're going to get to keep that money. If it's not tied up by, some kind of an endowment or something like that, they're going to keep it.
If this bill were to pass and if the sale occurred after July 1.
So they're going to get 100% of that income back to them for that sale. So looking into future, so let's just sell a few buildings that need maintenance. Let's just sell a campus here or there. We don't need that ag campus. Comments. Thank you.
May I comment, sir? Just responding off the cuff for myself, if I were to endow a building at a university because, for instance, Washburn Law, if I were to endow a building at my law school, I doubt that I would want it sold and have the proceeds to go to somewhere other than where I wanted those proceeds to go to.
So thank you. Further questions, committee? Seeing none, thank you for the overview. So from that, we will move to our neutral testimony from Capers and welcome Director Conroy to committee.
Good afternoon, Mr. Chairman. Certainly pleased to be here. Senate Bill 415, of course, as Arlene has said, this would provide the sale of state surplus property. In most circumstances, Capers gets 80% of that, as you heard. This would stop that transfer. It does date back to 2012, and that was sort of the dark days of Capers funding. And I believe the legislature at the time was looking for all potential avenues to help shore up the Capers Trust Fund. And so it was the creation of Capers 3. It was increased employer contributions. It was this sale of surplus property and some other things. But clearly, they were trying to lay all the cards on the table that might assist Capers, and this was one of them at 2012. As Melissa had certainly pointed out correctly, since 2012, on the page 2 of my testimony, it's about $1.9 million. Although the distinguished representatives from the Kansas State University think there might be one other that maybe, so we're checking to see, it might be just a little bit more, but it's in that neighborhood of $1.99 million that comes to Capers, and that's certainly a good thing. But again, as you look into that black box of actuarial funding, $1.9 million over 10 years, when you have an unfunded liability of $5.3 million, and it's not a guaranteed revenue stream, it's just ad hoc, and so the actuary never assumes any revenue stream will come in from this source. So because of that, the comment back from our actuary was that clearly this $1.9 million, while it certainly helped, did not have a significant impact on reducing the unfunded actuarial liability. And so, again, it's not factored in there. So there's no, I guess, actuarial cost should this bill pass, because again, it's relatively small amount, it's infrequent, and it's not a dedicated revenue stream. So certainly be glad to respond to questions as appropriate, Mr. Chairman.
So if there are questions, Director, do you know, I don't know that this is in your world, but I'm trying to think through the other processes and how many times there was also legislation that went around the 80% added to the language in the sale, and whether that was more common than actually leaving it there. Any anecdotal information on that, or perhaps if research has more color on that?
I may start, and research may have some additional comments. I think this list would be short compared to the list of properties that have been exempted from this provision over the years. And in more recent times, when agency comes to the legislature for the ability to sell some property, this exemption really is in the bill from the start. So I'd say that's almost kind of a common practice these days. Not always, but more than likely it's in there that this statute does not apply. So that money does not come to Capers, would be the common practice.
Thank you, Ms. Rennick.
And the Joint Committee, as I recall from our meeting last December, there were at least 6 bills that had been identified in the current biennium. There have been additional ones that have been introduced this year. For example, House Bill 2599 relates to property at the University of Kansas and conveyance of property from the Endowment Association. At the very end of the bill, prior to its effective date, is the statement: the conveyance authorized by this section shall not be subject to provisions of KSA 756609. And so that's a very common language included in each of those bills relating to university property, sale of surplus property.
Representative Dodson.
Just to add on, I think you'll find the same thing in 2600 and 2601 as well. Those were all 3 put together in the same hearing.
So other questions for our conferee? So appreciate going through each of those details, and thank you for the testimony. Is there anyone else that wished to appear neutral, since I started with neutral? All right, seeing none, we will move to our proponent testimony, and welcome to committee Mr. Matt Casey, Kansas Board of Regents.
This is on. All right, thank you, Mr. Chairman, members of the committee. Matt Casey, Director of Government Relations for the Board of Regents, and you've heard a very good overview from the reviser and Mr. Conroy about what this bill does, the mechanics of the bill. The first provision of the bill that allows the Board of Regents to authorize the sale of surplus property that was given as a bequest or gift or endowment, that came from the Board of Regents office as one of our recommendations. This would help eliminate some of the deferred maintenance backlog that we're looking at in our capital renewal initiative, and also reduce future maintenance costs. And the Senate Bill 322 that was introduced in the Senate that removed the statutory provision on 80% of the proceeds to be retained by the agency. That is a provision that we also supported in the Senate, and as you heard, those 2 were rolled together, and they both go together in helping going forward with our capital renewal initiative, reducing deferred maintenance issues, and lowering our footprint, decreasing our footprint, which in turn would save on our future maintenance. And so we stand in support of these provisions and also retaining the funds as we go forward with these types of land sales helps us reinvest those dollars on the campus for other needs. So I would stand for questions at this time.
Thank you. Committee questions? Representative Neighbor.
Thank you, Mr. Chair. Depending on where the property is sold, what university, is that the entity that gets the money? Or is it decided by the Board of Regents?
Yes, that's correct.
Thank you.
So thanks for your testimony and working through. And I've wondered a couple of things on the sale of property. Are there even times where the 80% prevented consideration of a sale, given that we'd rather hold a lingering property than give away that 80%?
Absolutely. That's always a consideration when addressing a land sale and that statute being present. So this would help address the sale of lands, and not having that provision in statute would definitely be more of an incentive to look at some of the surplus property that we have.
Thank you. Representative Riley.
Thank you, Mr. Chair. And property, I mean, we had this in Higher Education Committee, and one of the things is, so, you know, I noted the exemption that you have at the end of your property sales here. But at the same hand, if you do a fair trade with someone else, dollar for dollar, and it's the same amount, then it doesn't fall under this at all because there's no increase in revenue. Is that correct? If you just do a land swap, like KU and K-State would do a land swap, and there's no change in values, that wouldn't come under this policy at all. Is that correct?
I believe that is correct. We do have some representatives from KU and K-State that have done some similar items. I think that is correct, though, but I wanted to double check.
I would say to dispose of, so we had Kelly, Witten, University of Kansas, we have the 2599 that you referenced earlier. We would still have to come and get approval from the legislature to do that land swap. So, because revenue isn't being switched, so that really wouldn't be any part of either parts of these in 322 or 50. We would still come to the legislature and request the ability to do that and require law change.
Right, but since it's a 0 to 0, there's no income change, then you wouldn't have, it would true that you would have to maybe come and get the authorization to do that, but it wouldn't fall under this 80-20 at all. Right, okay.
So, and thanks for describing the other piece as we look towards the original part of 450 that just dealt with the process, regulations, et cetera, with the sale of something that might have been given to the university. The purpose was to help reduce the footprint, decrease maintenance costs, et cetera. Is that then what the sale proceeds would go towards? Not only would I, yeah, it may be hard to sell some of those that are on a campus property, but if I make that sale, is that what we are looking at directing these assets to, or is there any color around what those guidelines might look like to be established to sell those?
I believe that the sale of the proceeds would be retained by the agency, but not specifically towards any specific project.
Okay. And the bill would require the board to adopt policies governing the procedure under which they may sell and convey. So it would be more dealing with those procedures that would do it rather than necessarily directing where the proceeds would end up.
Correct.
Okay. Thank you. Other questions, committee? Representative Topliker.
Thank you, Mr. Chairman. On the list on the blue sheet, so none of those were endowed to any school.
I haven't seen the blue sheet list. I think that might be missing.
It's Mr. Conroy's. And so all of that, under this bill, all of that would still go to all of the proceeds from that, 80% would still go to Capers, right?
So this piece here, these list of items, if this bill was to pass, then these would be retained 100% by the agency. Am I speaking that correct?
By which agency?
Well, I'm not, it'd be Department of Corrections on one of them, Department of Labor on another one, so it would be those agencies that sell those properties would retain the
Oh,
proceeds.
okay, so under this bill, that's what we're doing?
Correct.
Okay, so this just going to the agency. And, all right, that was my question. Thanks.
Representative Riley.
So, Mr. Chair, I'm feeling a little bit better about where we're going with this bill. I think that was an important part that you brought out that's in Senate Bill 450, that they did not take away Section 2, I think it's C and D, where they actually will, the actual process of appraisal, verifying, all that kind of stuff, it's still there. We're not taking out the regulatory or that piece of the puzzle. We're just taking out where the money goes to. So I'm feeling a whole lot better about it, so thank you.
Thank you. And in case there is any lack of clarity, the dollars that came already in the past, we have and retain, but should a sale like that be made in the future, then it would not be made. So just as the point of history, and it sounds like the two main things that we're doing is changing what's happening with all properties that are sold, given that it was becoming more of a practice to go around the law rather than follow the law. And then allowing the chance to deal with particularly how to dispose of those properties that had been given or endowed to the universities with their guidance to meet those objectives as best possible, not specific to Capers. Reviser?
Thank you, Mr. Chair. I wanted to address the comment that Representative Riley just made regarding the appraisal and that process. On page 4 of the bill, line 2 through 7, it states, and this is old language all the way through the middle of line 5, it says the provisions of this section shall not be applicable to real estate given as an endowment, bequest, or gift to a state educational institution as defined in KSA 76-711. So those type properties have never been subject to those provisions that you're referring to on page 2, the process that the Department of Administration follows. Those processes refer to other sales and conveyances that are not bequests, endowments, or gifts. Just as an aside, the original Senate Bill 450 consisted of new Section 1 and the last half of line 5 on page 4 through there 2 on line 7. And basically that last portion on page 4 said the sale and conveyance of such real estate shall be subject to the provisions of Section 1. So rather than being subject to the provisions that you referred to, Representative, they're being pointed back to the policies and, the procedures that the Board of Regents is going to develop relating to those sales and conveyances. And I just wanted to make that clear.
Further questions? Representative Kelly.
I'm not sure that I understand this, but in the case of where the insurance building was sold, does 80% of that still go to Capers, or this takes all of those out? I mean, is this just the endowed property that's where?
Mr. Chairman, thank you. Yeah, I think maybe, the Capers piece and the Regions piece, I mean, they're involving the same statute, but they're sort of two different thing. So I think of the capers, the 80%, that would apply to any property sold by any state agency except, for these state educational buildings that through the endowment, bequest, gift. So yeah, so like if the insurance department, if that building would have sold and this bill had become law, the insurance department would have kept the entire amount of the proceeds. They would not have remitted 80% to capers, and that, or Department of Corrections or Department of Administration or anybody else. It applies to all the state agencies for that purpose there, except for that narrow bit for the universities, the state educational institutions as provided in the bill.
Does that address your question, Representative Kelly? Thank you. Further questions? Seeing none, thank you.
Thank
For
you.
your testimony. And we do have additional written testimony, and I'm not sure that I will pronounce Mr. Reisky with the University of Kansas, and Mr. Erickson with Kansas State University. We have that testimony, and I know Ms. Reynolds was also available for questions. So is there anyone else wishing to appear as a proponent of Senate Bill 450? Anyone wishing to appear as an opponent? And anyone else at all? Seeing none, we will close the hearing on Senate Bill 450. Committee, at this time, we will need to take action on it today. We can do that a little later. If you'd like to consider that while it's fresh in your mind, we can do that as well. Representative Neighbor.
Thank you, Mr. Chair. I think this has been well discussed, and we've been able to ask good questions on the bill itself. I would move that we suspend the rules and open Senate Bill 450 for discussion for passage.
Motion seconded by Representative Riley. Any questions or discussion? Seeing none, we'll move to a vote on the motion to suspend the rules. All in favor signify by saying aye.
Aye.
Opposed, no. Ayes appear to have it. Ayes do have it. On Senate Bill 450, Representative Neighbor.
Thank you, Mr. Chairman. I would move that we pass out favorably Senate Bill 450. I'm sorry. Substitute. I am so sorry. Substitute for Senate Bill 450, and thank you, Revisor.
Thank you. Motion by Representative Neighbor, seconded by Representative Dodson.
No, I just saw his hand.
A couple of hands over there. Any discussion or questions? If none, Representative Neighbor, you may close.
I close.
Heard the motion by Representative Neighbor to pass substitute for Senate Bill 450 favorably. All those in favor signify by saying aye. Aye. Opposed, no. Ayes appear to have it. The ayes do have it. Motion passes. Committee, before we jump into the next hearing, I want to take a step back that I should have done at the beginning. We have had minutes distributed for February 7 to 21. I would ask if you have had a chance to review those and take a motion on that topic. Representative Dodson.
So moved.
Move to approve the minutes from February 7th to 21st. Seconded by Representative Berquist. Any questions or discussion? Seeing none, all those in favor signify by saying aye. Aye. Opposed, no. Ayes have it, and the minutes are approved. Thank you, committee, and thanks also to our committee assistant for getting those before us. With that, we will move to Senate Bill 523 and ask the revisor to open a hearing with an overview.
Thank you, Mr. Chairman. Senate Bill 523 would authorize transfers from the State General Fund to the Kansas Public Employees Retirement Fund, the Capers Trust Fund, in both fiscal years 2022 and 2023. So these would be just revenue transfers from SGF right into the trust fund. For the fiscal year 2022, there would be a total of 2 transfers of $300 million each. The first would occur on the effective date of the bill, and the second would be on June 1st of 2022. So there'd be a total of $600 million transferred during the remaining fiscal year. In fiscal year 2023, there would be 2 transfers of $200 million each. that would be scheduled to occur on October 1st of 2022 and then January 1st of 2023. However, each of these transfers would require State Finance Council approval prior to the Director of Council reports making any transfer of the $200 million. To effectuate the transfers in the current fiscal year, the bill does become effective upon publication in the Register. Again, that publication date would be the date of the first transfer of $300 million. The Senate Committee on Ways and Means did amend the bill to lower the KPERS state and school employer contribution rates in fiscal year 2023 from 13.11% to 12.22%. And then it also established the rate in fiscal year 2024 at 11.08% to reflect that the transfers being made pursuant to the bill, the total, assuming the total $1 billion would be transferred, that would be those would be the new rates. And then, to sort of hardwire, if you will, the rates in effect, because if you might remember that without any sort of action to do so by the legislature, those rates wouldn't actually, the savings and those rates wouldn't actually be reduced. There's like that 3-year lag, so it'd actually be fiscal 2025 before you'd see any reduction in the rates due to these transfers. So the Ways and Means Committee sort of moved that up a little bit and set the rates at that lower rate to reflect the money being put into the trust fund. The Senate did pass 523 by a vote of 28 to 12 on March 9th, 2022, and I'm happy to take any questions, Mr. Chairman.
All right, committee questions? So in this bill, you described the schedule that they have over the next year to put in $1 billion, and I believe the Senate position would have been these payments of $1 billion in addition to Senate Bill 421, which paid off the layering payments. So those layering payments are not a part of this one, is that right?
That is correct, Mr. Chairman. Yes, the layering payments, that just about $254 million, that was done, the Senate position was to do that through Senate Bill 421. This would be an additional $1 billion to the KPERS fund to pay down the unfunded liability.
So thank you. Any further questions, committee? Seeing none, thank you for the overview. The fiscal note should be fairly clear on that, and we will jump into our testimony, and we do have a proponent. Director Conroy, welcome back to the Pension Committee. Glad to say that one more time.
Thank you, Mr. Chairman. Yes, KPER stands before you as a proponent on this bill, as you might expect, similar to some ways to yours, that ultimately adds $1 billion to the unfunded actuarial liability. And as David, of course, has certainly explained very well, it would reduce the unfunded actuarial liability by $1 billion and those payments then would come over 2 fiscal years, $600 million in the current year in 2 payments. So $300 million as soon as the effective day of the act, $300 million then on June 1st. So that $600 million is in the current fiscal year, and then the balance in that $400 million in 2 separate payments, $200 million each, October 1st of 2022, on January 1st of 2023, both subject to, those 2 payments would be subject to State Finance Council action. The funded ratio in Senate Bill 523 gets us from about 77% up to, the estimate is almost to 85%. For the state school, it would lower the unfunded liability, I think, like I said, $1 billion for state school, so from about $4.4 billion down to $3.4. And so the employer contribution rates in Senate Bill 523, as it stands now, would be hardwired for the current fiscal year and fiscal year 23 or 23. And so there would be employer contribution savings of starting out about $78 million a year. The first 5 years, the state, because of the lower employer contributions, because of the receipt of the $1 billion, would save about $422 million in those first five years. And as was pointed out, this doesn't involve the layering payments. If those would be paid off, that would save the state about $25 million a year in annual payments currently to KPERS. So this does very positive thing for the KPERS Trust Fund, lowers the unfunded liability, improves the funded ratio, and then saves you all employer contributions going forward. So Capers, Board of Trustees supports Senate Bill 523, and be certainly glad to respond to questions as appropriate.
So thank you. Committee questions? Representative Riley.
Thank you, Mr. Chair. Alan, I know that you've brought this point up in like Appropriations Committee before. So those are some changes as far as the employer school contribution. So the employee contribution for teachers, other Capers workers, not judges, not police, KP&L. So what are the employee contributions?
Right, for regular Capers, state, school, and local, it's 6%, and this bill would not impact that. It's all on the employer side.
Representative Miller, did you have a question? Yes.
So it doesn't affect current employees directly at all?
Well, not directly in terms of their
Yeah,
contribution.
that's my question, directly.
Not directly.
And as a retiree, it doesn't affect me and other retirees at all?
Not directly.
Thank you.
Representative Schmidt.
Thank you, Mr. Chairman. Walk me through this, if you could, please. Was it Senate Bill 421 we just passed in the House recently with $1 billion to Capers, and that comes, when is that taking place?
I believe, well, was that 2561? That was all in the current fiscal year. So those payments would have been made before June 30th of this year.
Okay. And then this additional total of $1 billion would take place, some of it in fiscal 22, some of it in fiscal 23.
That is correct.
So thank you. And Representative Hoy.
Thank you, Mr. Chair. That layering payment for 253.9 million SGF was in K-12 budget, and we took that out in committee, and it was suggested that it would be dealt with in a separate manner. If that's not in here, do we know the status of that payment, if it is being addressed in another manner?
So currently, it's in Senate Bill 421 that we passed from the floor. So that, along with the billion, is off of the House side. And then this one, we're hearing just to get an idea of the Senate's position overall and how that may play going forward.
Thank you.
So, thank you. Representative Smith.
Chair, Director, you mentioned 25 million. Forgive me, what did that?
Yes, Representative, that relates to those layering payments. Those are for missed prior Capers contributions. The state's paying us back over 20 years, and the annual payment on that credit card payment is $25 million a year. And so if it's paid off all at once, it saves that annual payment of $25 million, which is not in Senate Bill 523 anywhere.
So we're saving 422 million plus 25 million also on top of that?
25 million annually. So if, should those layering payments be extinguished, then it'd be that 422 plus 100 million, so you'd be over $500 million in savings there.
Thank you, Director. Thank you, Mr. Chair.
Whether current retirees would be affected, their payment would not, but the degree of stability might be would be impacted, I believe. So, Representative Miller.
As a retiree, how much does that put in my pocket? Nothing, right? The reason I ask that is because I think some people who went to the microphone, we had a similar debate, argued that somehow it was enhancing the money that retirees get. That's why they were supporting it. And I agree with what you said, but that for the people I hear from, that's not what they're asking for. They're not asking for greater stability. They're asking for more money.
And I would agree, does not add more money. It is possible for a young retiree that it increases the certainty that their payment comes, but it does not increase the benefit.
Yeah, if you're worried about the stability of the fund, this is something to be concerned about. I'm not, because most legislators are like me. They will benefit directly from the stability, and they'll see to it that it stays stable. Thank you, though. And I think I support the measures we've been taking over the recent years. It's made the fund more stable, and we're continue to move in that direction, and all the projections are in that direction regardless of what we do on this bill. So that is a concern. I have other concerns that I think are a higher priority to the people I represent. Thank you.
Thank you, and I would agree at what I assume your age and my age, that the stability of the fund is not a huge issue, and that the assets that are there will pay the benefits.
My age is a matter of privacy. I am a lot older than I look.
Thank you, Representative Schmidt.
Thank you, Mr. Chairman. Is there any discussion in the fact that our balance is so much better? Has there been any discussion about revising Tier 3 or eliminating Tier 3 based on better actuarial status?
I believe, and certainly the Joint Commission, the Joint Study, or the Joint Committee on Pensions this last interim mentioned that in terms of, there should be some attention paid to reviewing the sort of the benefit adequacy of KPERS 3. But this bill doesn't, again, directly impact that.
Representative Dodson.
Thanks, Mr. Chair. I was trying to do some math based upon what I thought I heard. So when we did 421, it seemed to me like we moved from 79% to 81 or 82%. And then I thought you just said 85. Is it? Yeah, I saw that.
I believe part of it may be, I'm trying to think, if that had the layering payments in it, and this is all just pure cash to the
That's the
trust
difference.
fund.
Okay, thank you.
If I may, I'm sorry, those layering payments, the actuary has assumed that revenue stream is already in the fund because the law says every year the legislature will appropriate $25 million to pay those layering payments for 20 years. So in the actuarial's world, the law is the law, and it'll be followed, and it'll never be changed. And so she has calculated that receipt of money into her projections. So that's why it doesn't move that needle, that $250 million roughly.
Representative Howe.
Mr. Chairman, when does the actuary do the next, I guess, comprehensive review?
Yes, it's on a calendar year basis. So for the calendar year that just ended, it's the last December, and then the Board of Trustees receives it in July. So it takes about 6 months for the calculation and all the analysis. So it'll be in July of this year, we'll get last calendar year's valuation report.
So thank you. On this topic, and I had talked with various folks about how to put in additional money last fall, and especially when the market was reaching new highs all the time, there was some concern about dumping it in at a point in time. And that's reminiscent of a moment in 2015 when KPERS wisely invested a large sum that was wired from a bond transaction at a point in time that turned out to be very advantageous for the fund, but frightened someone who might stand for election later that year in terms of exactly what direction the market might go in a few months. So as we look to that, and one of the Senate's concerns last year in bonding was, again, investing a large sum of money at a high point in the market. What we're seeing here is an effort to reduce that market timing risk by putting it in over time. I've also talked to the chair of the board to say, will KPERS exercise that discretion, or do we prescribe it to them? such that should market meltdowns happen in some of the situations going on around the world as they are today, and that provides a faster buying opportunity. They might have the opportunity to buy into that, or do we prescribe it in the manner that the Senate has so there's not a right answer to that, but something we will likely be discussing as we go forward with these bills with the Senate. So thank you for entertaining that discussion. Are there any further questions? Seeing none. Alan, thank you again for your testimony, and I also want to say thank you for your testimony and your help over several years in the legislature, dating back to 2011 for myself, certainly Jared as well, although he got excused from the 2011-2012 work until we captured him there, and also Chairman Kelly for leading this effort for a period of 4 years in that time frame. So many thanks. I don't believe we have other conferees. Is there anyone else wishing to appear as a proponent? Anyone as an opponent? And anyone neutral? And anyone else at all? And if not, we will close the hearing. Thank you, committee, and to the conferees. So that takes us to our next item of business, which would be considering Senate Bill 377. That is a bill that related to captive insurance products and the ability to do in-kind investments. And just to bring that back to mind, we'd ask the revisor for an overview. Yes, you may.
Thank you, Mr. Chair. Since my partner in crime has kindly stepped into my shoes and is passing out the balloon, Senate Bill 377 allows for the creation of technology-enabled fiduciary financial institution, or TEFI, insurance companies within the Captive Insurance Act. Just as an aside, this is the Senate version of our House Bill 2547. And the amendments that this committee made to House Bill 2547 were also made to Senate Bill 377 that is under consideration now. The bill adds a new section to the Captive Insurance Act that establishes TEFI insurance companies and establishes the requirements for TEFI insurance company operations under the certificate of authority that would be granted by the Commissioner of Insurance. It permits a TEFI insurance company to provide contracts of suretyship and credit insurance as an exception to the general prohibition against captive insurance companies providing surety services. It exempts a TEFI insurance company from the requirement that the word captive be incorporated into the name of every Kansas captive insurance company if the TEFI insurance company complies with the naming conventions required in Section 1. And it allows TEFI insurance companies to hold in-kind assets, and such in-kind assets required to be held or shall be counted as part of the reserves, capital, and surplus of a TEFI insurance company. And the bill would become effective upon publication in the Register.
So thank you. And just going back, we had a House bill virtually identical to this. I think the
Totally
amendments that
identical,
we
Mr. Chair.
did were the same amendments that they did in the Senate. So it's language that we would have seen before on that.
Exactly.
So thank you. Questions for the revisor? So seeing no questions, committee, my intention on this, we have that identical bill in the Senate, and we don't necessarily want both of them to go to the governor's desk. So I had asked for an amendment to this bill that is in the balloon that was handed out. If you look at that massive change to wrap your head around in statute book versus register, that is the amendment that we would propose. But with that, I would start with the committee's wishes on the bill, and
Mr. Chairman.
Representative Berquist.
Yes. I would move that we move the Bill 377 out favorably for passage, and then we'll consider the amendment.
Okay. Motion to pass favorable, seconded by Representative Neighbor. Discussion, back to Representative Berquist.
And we have the one amendment that would like to make a motion to approve. That's to change in line 34 of the handout you just received, change from Kansas Register to statute book for the date of actual action.
Seconded by Representative Neighbor. Thanks for the other options on that. Questions on the amendment? If there are no questions, Representative, you may close.
I close.
On the Berquist motion to amend, all those in favor signify by saying aye. Aye. Opposed, no. Ayes appear to have it. The ayes do have it. Representative Neighbor.
Thank you, Mr. Chairman. I move that we pass out favorably as amended Senate Bill number 377. And I did say as amended.
So thank you. Seconded by Representative Riley. Thank you. Questions? Seconded by Representative Riley. Questions, committee? Seeing, Representative Dodson.
Thanks, Mr. Chair. Just kind of an administrative question. I had this same thing happen in Veterans Committee where we had mirror bills on both sides, and it has really tangled things up. Do I understand this process where we make one amendment will fix that? So in other words, when we send it over, it will now be just one bill.
So thank you, Representative. It'd still be two bills, but what it does is it would send this one back to the Senate rather than on to the governor. If we each passed a mirror bill, then we get tangled up. Right. If we each plan on at least where we had mirror bills, which we had more of this session than other sessions, again, having some uncertainty in January how long we'd be here, that's the concept of saying, okay, we'll add an amendment to some of them so that we at least have a plan to have a chance to catch that.
Thank you.
So thank you. That makes sense or not, Representative?
I just have to ask, why don't we just do nothing and let the one bill go to the governor?
So that is an option also. And the one thing that we have on this would be the belt and suspenders to say if anything comes off the rails on that side, we can move this bill forward. So whether it comes above the line or not, I'm not certain. But it is the only answer is the belt and suspenders piece on the process. We know we want it to advance. The second piece would be the other vehicles that are there. So
I think it's helpful to review that process.
what's that?
So I think it's helpful to review that.
So thank you.
Do a lot of things around here without asking why, and sometimes that's helpful. Thank you.
Thank you for asking the question. Representative Howe.
Mr. Chairman, I'll take this as a learning opportunity. So even if there's mirror bills on originating in different chambers, and they have different bill numbers, they would be considered identical. Is that kind of the view of how it's treated here?
Well, so they're different bills, but when they are identical, it creates some unique issues, and the reviser may be able to explain more of what happens, what would happen if both chambers passed a mirrored bill and the same thing attempted to go to the governor's desk. That's where I think you have a wreck on the road, and you just want to make sure that the traffic is set that one vehicle actually proceeds. So in this case, should they both proceed, it at least sends one back to the other chamber.
Yes, I understand that. I was just curious if the bill number, if you introduce identical bills in each chamber and they had different bill numbers, are they still considered identical? Or, you know, if they passed each chamber?
So the content is identical. Of course, you've got the Senate bill with 377 and the House bill with, was this 2547? So clearly you have that moniker that's different, but the content is where you have the challenge. So if that's clear enough. So thanks for the discussion on that, committee. So discussions on Senate Bill 377 as amended on the motion to pass favorably. If there is no further discussion, Representative, you may close.
The real reason we're doing this is so I can write another bill brief. Don't kid yourself. So with that, I move my motion.
Thank you. You've heard the motion by Representative Neighbor to pass Senate Bill, a substitute. This is not the substitute. That was 450. Now I'm getting myself. Pass Senate Bill 377 favorably as amended. All those in favor signify by saying aye. Aye. Opposed, no. Ayes appear to have it. The ayes do have it. Thank you, committee. The bill is passed. Committee, we have one other item to discuss, and that relates to two bills that we heard earlier on working after retirement. They were 2593 and 2639. And how to proceed with those is still a little murky, but we wanted to talk about that issue, and we have some other talent here to help us talk about that. We may want some information from Capers on working after retirement, but I would ask Representative Schmidt to start with the topic and what our objective might be.
Thank you, Mr. Chairman, and thank you for allowing us to be privileged to be part of this committee. What we're trying to do, and I say we, Representative Hoy and myself have worked closely with Representative Johnson and Kelly in trying to solve a problem that we have, which is a shortage of teachers. We currently are told that we have 1,400, we're short 1,400, we have 1,400 vacancies, and we can only see that getting worse as it goes. So we were trying to, and we had separate bills introduced with different issues with them, but what we're trying to do basically is three things. We're trying to fill vacancies in schools, not just teachers, but any vacancies. We're trying to, and to do that, we've looked around and said, where is the greatest pool of qualified people? And the greatest pool is in retirees. We know they're not coming out of the schools in the numbers they had been, so the retirees. And then the third issue is, how do we do this? How do we incentivize retirees to come back to school without without having a negative impact on Capers? And so that's what we're trying to do. So we introduced 2593 and 2639. Do you want us to go into the details of that then? On 2593, basically what we're saying is reduce the original bill, we said reduce the waiting period to 60 days, and then there's a 2-year sunset, and we would eliminate the 30% penalty on earnings over $25,000. We feel like that is quite has an impact on people's interest in coming back and teaching, to have that 30%. So we would take that off for a 2-year period. That was the original bill. Now, we have a number of amendments and other ways to go with that, but that's what we had, and I think Representative Hoy can speak to her bill, if you're okay with that, Mr. Chairman.
Thank you, Mr. Chair. Each bill was an attempt, as the previous representative said, to solve the same problem, and there are multiple ways to do it. 2639 addresses the waiting period, and it applies to all Capers retirees. It's not specific to K through 12, so there are some differences there. Should I discuss further the need for this, or would you prefer to wait until we have any motions before us? It did get brought to my attention today. I got a report. Kansas Teacher Retention Initiative, Emporia State worked with a few groups to survey teachers in Kansas. And this is very recent information. 2/3 of school districts currently report experiencing teacher shortages. 55% of teachers are planning to leave the classroom earlier than anticipated due to COVID. Teacher preparation enrollment was down by 1/3 from 2010 to 2017. For the first time ever, a majority, 50% of parents discourage their children from becoming teachers, and teachers teacher vacancies increased 62% between the fall of 2020 and 2021. And I'd be happy to send this survey on, if the committee is interested in seeing this, but some of the questions that they asked of what teachers were very satisfied with versus dissatisfied. There's about 35 questions here. The top ranking was the location of the school district where you teach. And the second to last was the lowest ranking, the ability to request and secure a substitute teacher for your absence. So this is a serious issue that is driving teachers to reconsider their profession. The lowest, sadly, was society's view of the teaching profession. So I think having this discussion today and looking at ways we could help with this and solve this does go to show that we are listening to teachers and listening to this problem that our state is facing right now.
And I might look to our Capers team, and did you happen to have any information that we could pick up as well? And welcome back, Director Conroy.
Thank you, Mr. Chairman. We've got some, and we'll give it to Colleen or staff here. And it's just a recap of the current working after retirement provisions. So, and just to recap, just remind people, you know, the working after retirement provisions, at least some extent, are there to keep us square with the IRS. And the current law says if you retire before age 62, you have to set out 180 days. If you retired age 62 or over, it's 60 days. There can be no prearrangements. That keeps us square with the IRS. There's no earnings limitation on the retiree. If a Capers employer hires a retiree, they have to pay the statutory rate, whatever it is, on the first $25,000, and then it's 30% on anything over $25,000. And we know some employers negotiate that assessment payment, reduce the compensation they're offering to hire the retiree back to cover the assessment. And anyway, I'd be glad to provide additional information, but it's 180 days, less than 62, 62 and over, it's 60 days, no prearrangement. There's an assessment the employer pays or the retiree indirectly pays. Again, it's in general to keep us square with the IRS in one manner or another.
So thank you. Thanks for an overview. Does anybody have questions for Director Conroy on this information? Representative Smith.
Thank you, Mr. Chair. Thank you, Director. I was just wondering, if you retire 60 days, when you come back in, are you on the same step as you were when you left, or are you at beginning teacher salary?
Can I answer that? That depends on the school district. I've done it both ways. Sometimes you put person in at that step, or sometimes you negotiate something lower. And also, like Director Conroy said, as far as paying the penalty, some school districts take that themselves and give the person the full salary. Other districts might say, we'll take that off your salary, and then that goes into Capers for the penalty.
Thank you. Thank you, Director. Thank you, Mr. Chair.
So any other questions for the director? And thank you for that overview. Appreciate that. I know some of you know this stuff cold. Others, I thought it could be helpful just to know what the base rules were. And then to our folks looking at it, kind of helping us see which piece we're moving as we go through the process was the goal on that. And Representative Neighbor.
Thank you, Mr. Chair. If I remember the conversation that we had during our working or looking at this testimony on the bill, there was concern that this would incentivize teachers to retire early and then come back. Is there anything in one of your amendments that addresses that issue that could relieve that concern? And I would add a second thing to that. And I know we had a conversation on waiting period and issues of that nature, or how long to sunset this, I'm sorry. I think we have to be ever vigilant that this is not a one-year problem or a two-year problem. Replacing teachers in the classroom is going to take some time. I think this is an opportunity, if there is an amendment available, to look at that, tighten the parameters, and hopefully bring back those who have the experience, because a lot of the teachers that we're losing are in like physics and math and science and areas that are critical to the education of all of our students. And when somebody was talking about bringing back a teacher at one price or one salary or another salary, I think that would be decided at the school level because of how hard it is to fill a position in certain areas. And there are very difficult areas to fill because of the training and the specialty. And I'll turn it back over to you for your question now that I rattled.
Or for the response to the question, if one of the amendments did address the concern about opening the window to incent someone to retire, was that the initial question? Yes. If either of you would wish to respond.
Yes, we have talked about this, and again, we want to encourage people who have retired to come back, but not incentivize people to retire early to take advantage of this. So one of the ideas we had was we would, if a person has been retired for 1 year, they would be able to come back without paying that 30% penalty. They would just pay the statutory amount. That would mean somebody, for instance, who retired last year could then come back this year. That would not allow someone who retires at the end of this year and says, oh, this is a good incentive, so I'll retire and go. No, because they would have to wait a full year. Now, where the complication comes in is the person who had already retired and then came back to work, what do we do with them? And, you know, my suggestion is if they've been retired a year, we remove the penalty. There will be some cost to that. It will be, I think, fairly minimal cost, but there will be some cost to that. But we're open to discussion on that.
Representative Riley.
So I just want to add my commentary and maybe answers to the previous two representatives. First of all, as far as changing the ability to retire, that is, as you know, based on getting a certain amount of age and points of years of service. So we're not affecting that. Once you make that decision that you're going to retire, you have the 85 points, I think I'm right on that. Once you have your 85 points, you retire, or you start making your decision to retire. So we're not, by change, I'm not, but by making this change, you're not affecting someone's decision to make that choice. What you're looking at here is their ability to make that choice to come back after a certain rest period and do it. The other piece that I would like to bring out to both previous representatives is, you know, if you do come back within, I'm going to use, if you did do 60 days, or if you did a year, 2 years, or 5, even in my case, you still have to have your certification renewed. So if you are not a certified teacher, you're not going to get hired on anybody's scale. You could be a para, you could be a substitute, but you're not going to be a certified teacher, and you're definitely not going to be a highly qualified certified teacher. And so this is not affecting those things at all. Now, if I had my preference, I'd like to see this whole penalty thing gone. And so, you know, if you're working on your amendments or whatever, to me, going back to the things I've just said, I don't think that if you have a certified teacher that's coming back and you're going to negotiate them on whatever scale, I think that 30%, not 30,000, that 30% should be gone Give them $100,000, give them $75,000 to come back and teach, whatever, but don't penalize them. If they are certified and have maintained their teaching certificate, they should be able to come back. So that would be my comment on this. Thank you.
Representative Dodson.
Yeah, I guess my comment's a little bit along the same line. When you look at some of the reasons that the teachers are leaving, I applaud what we're trying to do here. I'm just worried that almost anything we do on this end, on the retirement side, will not provide the kind of numbers that we're seeking, particularly over the next couple of years. And kind of on that point, I would be worried if we extend the period of lack of penalty, because then it just becomes expected. And we really don't know, given what I said before, if this is the most effective means in order to retain or bring back teachers. Just to make a short story long, when I went down to listen in Salina, when we had the meeting down there, I mean, one of the things you mentioned was the lack of respect that they're feeling. And that's really hard to turn around with an incentive of this type. It doesn't mean it doesn't do much, but I'm just again worried that this kind of thing will not address the real problem that we have to get to. So again, I applaud what you're doing. It's just that I have worries about this.
Representative Kelly.
Mr. Chair, and working after retirement was the life that you assigned to me several years ago, and it took quite a while to get to a point that the big complaints were over, and it was working, and so I had a thought that came about 3 o'clock this morning, and I just want to toss it out as maybe a short-term prospect to spend maybe the interim and over the summer, in next session, to look at maybe a long-term so there's not any unintended consequences, which we kept finding as we went along and made little tweaks to working after retirement and all. But one thought, the thought that came to my mind was on a short-term solution, a 1 year, the upcoming school year, that anyone that had been retired a year, had not been working, could come back and take a position. And in this, it would cost Capers nothing for the fact that there's the $25,000 earnings limit, which I would suggest maybe, and I'll ask Alan and Jared, when we did working after retirement, didn't we have a kind of a time period where we'd look at that 25,000 and adjust it upward? I was thinking 5 years maybe.
Hey, Mr. Chairman, there were some provisions to periodically look at that. That was in the previous working after retirement, I think in 2017 or 16, but in this last version, the one we're currently operating under, that provision was not part of that. So it was there before, but in the grand compromise, that part fell out. I remember correctly.
Okay, but I would suggest maybe going to, I think, looked at what the 25 might have been since we did it, and maybe go to 27 and a half, something like that. So someone that would start in this semester that hasn't worked in a year would mean that they haven't worked in 2022, so they could earn the 25 now or the 27.5 in the first semester. Capers, that amount resets January 1. So they could work the second semester and not have any 30% penalty, most likely, and fill a position. So I think I had originally thought 62 and over, but I'm not so sure even if you get down to someone in their 56, 7, 8 that's been retired a year and hasn't worked, that you could maybe bring them back under this. I've checked that with Alan, but I thought of that. But then someone that you hired the second semester to do the second semester of the school year that hasn't worked, has been retired, then they would be able to earn basically 27.5 or 25 in that second semester, and the program would then terminate at the end of 2023. And so you would have no cost to Capers because the 30% wouldn't come into play. You would have maybe a workforce that you don't have to worry about the waiting period because they've already set out, and you'd have a year to come up with something that may have all the unintended consequences somewhat worked out of it for it to what to look to go more longer, on a longer-term basis. So that's just a thought to throw out that maybe wouldn't punish Capers, might get some people and give a year to come up with a solution.
Thank you, Representative Neighbor.
I just need a point of clarification on that. So when you're saying the 27.5, you're talking about the first semester, and then the same person can come back second semester.
Because,
You have to have a higher salary because 27.5 for a year is not an incentive.
well, that would only be, you would be hiring, the Capers amount resets January 1.
Right.
So you would have if it was 27.5, you'd have 55,000 is what you could have without any penalty even coming into play now. It would just be the statutory rate.
Thank you. It was just point of clarification.
And then the person that came on in second semester only, they would have, since it would terminate at the end of that semester, they'd have 27.5 to earn that one semester that they worked. And then maybe there could be something else in place by the next school year.
Thank you, Representative Riley.
Just to address a little of the previous representatives and previous chairs' concerns on that. You know, in the world of the school world, we do everything on the whole year. And I'm just afraid if we started breaking contracts down to a semester and then second semester, you're going to have a certain amount of instability as far as the school of whether they can offer a class because of a math teacher being there only second semester. You know, they would have to have two separate contracts, and typically we do a 180-day whole year contract for teachers. I just throwing that out to your idea. Maybe you can improve on that.
Well, my thought is that the one you would hire for the fall semester and the spring semester would be on a full year contract. And if you had second semester came up and you lost someone, you would be able to replace them for one semester, and that's all that would be left in that school year. So you'd be able to replace them for one semester and have the 25 or 27.5 or whatever you chose, if you wanted to raise it, to work within that period. And it could get you through with no 30% penalty potentially. And I might ask Alan, if you could go under this less than 62, which I'd originally talked to you about, because of the fact that it'd be a one-year program and they would avoid the penalty anyway if they came under that rate. If they came under the 27.5 and then it reset and they had 27.5, whether you could go to a younger age?
I think that'd be, a policy decision and just kind of how you want to craft this one-year window transition, if you want to.
And I was thinking only someone that had not worked, so they would not have any other, and they would have fulfilled their waiting period.
That's correct.
So if I can just do a bit trying to pull together what I've heard so far, and then Representative Riley, you were the next hand that I think I saw. We had the concept of if you're retired 1 year, we would have a reprieve from the assessment of 30%, just pay the statutory amount as a way to try and get people back in the fall 22 timeframe, hired and in position in schools, et cetera. So that was the concept, and setting that up so that if you're retired for 1 year, then for 1 or 2 years, that would not apply. To that, I hear Representative Kelly saying, perhaps, if we are wanting to do that for someone who has been retired for at least a year, we, without doing anything, have the ability up to whatever the threshold is to go through the fall. It resets in December, and I get another threshold amount for the rest of the school year, which would allow someone under current law making $50,000 and under the numbers you proposed making $55,000 for 1 year to not have the 30% assessment, irregardless of age, given that that would be the rules that apply, and focus on an interim to have a solution by a year from fall to see if there's something that we can do rather than trying to fit that into today's bill. Is that what I was hearing? And second to that, your piece being with inflation, take that number from 25,000 to 27.5. So just to throw some of the things out there that are there. Representative Riley.
Thank you, Mr. Chair. And I think we're going in the right direction. But if we're going to change this number from 25,000 to 27.5, we might as well make it 150,000. That would, or zero, just take it off completely. That's where I'm at. So instead of trying to give an inflation index so that 5 years from now or whatever, either we take it off or let's make it a big number so that it doesn't apply to anybody. That would be my comment. Thank you.
As our hour approaches, we'll continue to try to think how we can come to us a consensus, which is a tall order, but I appreciate the efforts to try and do that. Representative Howe.
Not to belabor the time, but is there a state statute that says that if you are a state employee that you have to offer a KPERS benefit? Because maybe that's the solution. If you've met retirement eligibility and you've been out for a while and you want to come back, maybe there could be something we could change in statute that says that you don't have to offer KPERS.
Okay, thank you. And it gets a little confusing in there. So we don't continue to offer KPERS, but to increase benefit, et cetera. But what we found without the guardrails is that there was apparent intent to retire at an age earlier than I planned to fully retire, in that I could maximize my retirement payments and my salary. And that had a cost, and it ran afoul of the IRS stuff, which is where we wound up trying to find our way to somewhere forward. Representative Kelly, did you have another point? Okay, thank you. I apologize. I may have missed that. Representative Schmidt.
Well, in the interest of trying to come to some kind of a conclusion, I like what Representative Riley is saying. I think, you know, we don't only have a teacher shortage, we have an administrator shortage too, and you're going to get above that 50,000 or 55,000 mark, even with teachers, because these are going to be older, experienced teachers with master's degrees are going to be making 60, 65,000. So I would like to just eliminate that amount and say if you've been retired for a year, you can come back without the penalty. You just pay the statutory amount. Now, where the complication comes is if someone had retired previously 1 year, 2 years, 3 years ago, but came back and did teach or did work in a school and was paying the penalty, do they go off the penalty now too? And that's the issue that we we had to talk about as well. And I think what I would suggest is that we do this on a one-year basis and say, anybody who's retired a year, you no longer pay the penalty. I don't care if you came back to work or not. And then it gives us time to maybe in the interim to figure out a better long-term plan for this. I don't know how that resonates with people.
Representative Kelly, and then if there are some amendments that are drafted that we want to put forth, we might start looking at those. Representative Kelly.
What I would say is before you decide at this particular moment in time to eliminate the dollar amount, I think that's a decision that the interim could look at, because this would be a spur-of-the-moment decision that could have unintended consequences on the CAPERS system. And you may want to adjust the dollar amount or whatever, but I think that anything that we do, and I know that the representatives have been working on it, but it took us several years to get to one where we solved it. So I think, and some of those things that we were trying to solve came because of short time period decisions that turned into things that turned into be a problem. So I can understand the administrators might have an issue, but you know, they would have $55,000 in this one-year period exempted from the 30% penalty, and then come up and have a chance to look at all of this and not have something that we go, ooh, we got to fix that now. And although you still will probably have a few things that when you do it like we did and you find something and you go back and correct little things, but this was just a thought to get through this year and actually be able to spend some time to do it and try to not go from where we've kind of been for these past years, not near as much turmoil on it as we had my first years when Chairman Johnson assigned it to me, and come up with a good solution on this, but not have the impact on the system, because you're not waiving any penalty on this to any big degree. Or if you do, if it is, it's a smaller, much smaller dollar amount.
So thank you. I may throw out a couple thoughts and a concept for a starting point, and we can throw it out or move forward. One of the questions that we asked of CAPERS was where people fall. 76% of retirees for the year are under 25,000 now. So a pretty solid majority, certainly not all. If we go to 50,000, that picks up a lot of the remaining folks that are working after retirement. I don't have the percentage for you. I could add it up. The school group would have not quite 2,400 retirees under 25,000, 434 between 25 and 50,000, 220 between 50 and 100, and 12 that are over 100,000. So of the groups, if we were looking at the focus of getting folks back to work in the fall that could come for the full year and be under that amount, we would get a lot of them there. I had not thought when we first talked about it, about the reset happening in January, which may help, may hurt that. I think we could go either way and say we'll try and get through the first year and come up with an interim report, or we'll try and set it for 2 years and then adjust it back if the interim would do that, and perhaps get to a similar place. But a thought would be to put forth the 27.5 as an idea in the bill that might have a shot at getting above the line to continue the discussion and move it forward and see if we continue to work on another thing here or with the interim to get more specificity as an option. I'm not saying that you should settle for that by any means, but one thought that is out there that we could work with. And I'd be open to other, if that makes any sense, even to start with, if you know what I just said, which would be we change the threshold to 27.5. That's the bill, and we take that step. Or is there another one that we might be able to describe for the committee?
I think you should make a motion on
Are you open to that one? Representative Hoyle, I'll start with you.
Agreed. Well, I just have a question.
Yes.
Is this would be applicable to all Capers employees?
This, I believe, needs to be applicable to all employees.
Okay, and this would be permanent or a sunset?
I believe we've set this up as an ongoing proposal to take just a little early, a slight move on the inflationary side and just set that different rule.
Sounds good. Do we need
So-
to open up a,
So is this the balloon that roughly does that? Thank you. And again, I don't mean to end the discussion, but wanted to make some progress. So I'm not sure whether you go to Representative Riley or Representative Schmidt. I think I'll go to Representative Riley, although yours may have been on a different point.
Thank you, Mr. Chair. Well, I had 3 questions. Now we're down to 2 because.
Don't let me eliminate them necessarily, but if you're willing to go with me on the time, that's great.
Well, my first question was because it seemed like we were off onto the other bill and we weren't discussing the 2639, which included all employees in our discussion. We got down the track of just talking about teachers. The second thing is I know for Alan, this is a policy issue, not necessarily a monetary issue, but I'm just wondering, this year, or if you have last year's information, do you have any information that tells us how many employees are paying that 30% penalty? So that was my question to Alan. My third point to you, Mr. Chair, is, and I've seen those numbers on that scale before, those are the incomes of the current employees or retirees. That's not what their possible income would be if they were to go back and teach or be an administrator or be a clerk in a job, a government job. Though, you're just thinking of how much money, those figures that you have are how much money, those lump things of how much income those folks have now. But if they go back and negotiate a repricing of a contract for a school, that's not the employees, the numbers that you have, that's a different number. That's a $55,000 for a school year dollars or $65,000 for a school year. So I just want to say that there's a difference from the figures that you gave us comparison to what they would negotiate in a school contract.
I think the table that I handed Representative Kelly or you is the actual salaries of the folks working after retirement by the distribution group. Again, not
Retirement income.
right. So for that group working after retirement, what is their income in working after retirement?
But that's not the new amount that they would get when they negotiate going back to school. Let's say they go back and negotiate a $65,000 contract with the school. That's not the retirement income, which is on that schedule of what they're making for income.
It's not from
now.
capers. Right. But are you saying it's their capers retirement income or their retirement income from working at the school?
Well, that would be my question because those figures do not show what they are going to renegotiate with a contract with school or an entity or whatever. We're talking schools right now. But so if I have $30,000 that I'm making off my retirement income and I negotiate a $65,000 go back to school, I add those things together and I'm way over, right? So I'm going to be paying federal tax, state tax, plus a penalty on all of those.
I think looking at this doesn't include their capers retirement payment at all. This includes what they're making at the school. And I mean, so they would, because I think that's what it is. This is in addition to retirement income.
Yeah, in addition to the capers retirement income, yes. And that wasn't in our test. That was some additional information we asked for that you're welcome to look at if it addresses any part of your question, and it may not. So were there others beyond that, or was that the focus? Thank you, Representative Schmidt.
Well, I'm just wanted to be clear. So now this amendment would say, we're talking about all capers, not just school capers. Okay, so all capers. And we just, basically what we've done is we leave the waiting period the same. We've just raised the threshold to 27.5. That's what we're saying. Okay.
And that is this one, and I'm not saying that you should settle for that. I'm saying you can. I think if we change the 27.5, we want that to be consistent across all groups, if that's the direction we go. So that is for your consideration. I'll let anyone else make that motion if you want it, and I'm open to other amendments that we might have on the floor. Representative Neighbor.
I think what this actually does is it's a starting point for raising the capers, which would have to be done. This doesn't include any of these amendments, so be aware of that. It just, it brings it up to date, and it's for all members. So this is the base start that I think Representative Kelly was talking about that was needed, and places it in a position for an interim committee, and then also for any other amendments that might be brought to this bill. This has to be done first to set that level. I would move this amendment.
Motion by Representative Neighbor, seconded by Representative Kelly. Discussion on the amendment. And if you wish to offer an alternative amendment, I don't mean to railroad it down the track, but wanted to give us a track to run on. Representative Howe.
Mr. Chairman, I had a question for Representative Hoy on the survey. I had a question about the survey. Was there a breakdown of information as it relates to the respondents that were younger than the age of 62 versus over the age of 62? I didn't know if there was any information as it broke it down. I was just kind of curious about the wait periods and who was responding in which different ways.
I don't have it that close, closely reviewed, and I would be very happy, as they have like roles of educator, there is some other information in here, and Mr. Chair, if it's okay, I could send it to the assistant to send out to the committee, or I'm not sure how you do that in this committee, but I'm happy to share it.
Thank you, thank you. Yeah.
Thank you.
Representative Schmidt.
Thank you, Mr. Chair. I think if we do this, I mean, I would like to do more, frankly, but this is something. If we do this, I think we need to make it clear, and maybe Mr. Conroy could address this, but that people understand that if they come back, they would not actually pay any penalty the first year because of the restart on the first of the year. So at least for 1 year. Do we feel like people understand that? I mean, that's the case now, really. Do they understand that? And is that, can we make that clear to everyone?
And we have a former superintendent that might be able to address that. And I would even say, Mr. Carl Skin, if you have any thoughts on that, they would be welcomed also.
Well, I think, these are new rules. I retired before we got into all of these complicated rules, so I really can't say a whole lot to it. Maybe you can address it better than I could. And maybe part of that would be if you think this would incentivize some people to come back.
For those of you, I'm Jim Carlskin, former representative and former superintendent, and thanks for asking. I think I see what you're doing. I understand Representative Kelly. I've worked with him several years, and we talked about this for, over the years that I was here. I think what you're doing with putting this 27.5 on is a start. But this will give you, based on the time of the day, this day, and the time of the session, I think there needs to be more added to this to get people back. I've got family. I've talked to a lot of people in the field that are still in the field, that are leaving the field, and this is just a step. And it was mentioned earlier in this conversation, to get people back. It's going to take more to get people back than just this. But I think it is a step. We have to incentivize the younger people to get into the profession, not people that are at the end of their career. You know, I do think the year penalty has to sit out a year, I think that's a factor. You know, and I know that's a difficult one to work around, and, Director Conroy, he needs input on this. But I think there's some amendments that can be done to this legislation to help it. I don't know what it will look like when it gets on the floor, but you probably need, with this amendment, you can amend it on the floor as well. So, but we need to work on it to offer incentives further. I don't know if that answered any questions or not.
Representative Smith.
Thanks, Mr. Chair. You know, a couple years ago, maybe it was 4 years ago, we needed a chemistry teacher at school, and there were 0 chemistry teachers graduating from our Kansas colleges. And I'm thinking people like that, chemistry and physics and so forth, if they retired, they're not going to have a teacher's certificate, and they're not going to go back to summer school so they can do it. So that's something we just need to consider also as we go. Thank you, Mr. Chair.
Excuse me if I can, I think what the state board did earlier this year to relieve the substitute teacher issue, to let, 18-year-olds with a high school education, be substitutes and, the clearance. I think there needs to be some tweaking with respect to, what Representative Smith just said about, people let their licenses lapse. That's an issue too that I think that we can work with. But it needs to be, we're going to have a lot of people leave the profession, come May of this year. And there's going to be, there's 1,400 openings right now. Come September, we could be looking for a lot more. So I do hope we can do something, because I talked to a lot of superintendents, principals, and it's a problem right now. So I won't belabor the point because it's getting late. It is late.
Representative Berquist.
Yes, Mr. Carlson, thank you for helping us out. When you said that it would be a start or it'd be a help, are you saying that you think it could be a help, even if it was the only thing that happened this year as a start, or would it have to be something else added to it?
To be honest with you, if the only thing is done to this bill, if the only thing is done is to change it from 25 to 2750, it's not going to do much. It's going to do very little.
Thank you. Thank you, Mr. Chair.
In my opinion.
So thank you, and I would agree. It would do little. It'll help some that we pick up that are off of there. It makes it a slightly lower penalty. The two things it does is that tiny change and potentially give us a vehicle that we can continue to use going forward, unless we can come up with another one that we would agree on to pass at this time.
What do you feel like the feeling of the entire body would to amend this on the House? Because I don't think there's amendments ready today to do it. Could you get it amended, when you're on the floor?
It is possible there or in conference committee that amendments could
Probably
happen.
conference would be a better.
So. Representative Schmidt.
Mr. Chairman, in light of what we've heard, I just don't think we're going to get very far unless we make something meaningful. And I would like to move an amendment that says we have a 1-year waiver on any penalty. I would like to put that amendment to the bill that you have. I think you have that.
So the way I understand it, and if my process is correct, I can't have two amendments on the floor, so this would be a substitute where we would have what Representative Schmidt has, and do you have a draft of that for us as well? Okay.
The reviser has that, would be.
So that substitute motion is made seconded by Representative Riley?
And the substitute motion is 1 year waiver on the penalty for anyone who has been retired for a full year. You have that.
Thanks, Emil. Do you want him to explain that, or do you want to go first, Joella? Okay. Representative Schmidt to explain.
Okay, just for clarity, let me explain. What this amendment does is it would be an amendment on the amendment that was offered with the 27.5. It is a waiver for 1 year. It is for, okay, it's for 1 year, and it waives the penalty for 1 full year for someone who has been retired for a year. And what we have to do, if you see on page 15, we have to change, it says June 30th, 2024, we change that to 2023.
Well, I mean, I think that since we're not doing anything, since they're retired, we don't have to worry about an IRS issue because they've already hit either the 180 or the 60. But it'd probably not have much impact because by the chart that we got, a lot of the retirees won't come under the penalty anyway. So we're mainly talking about higher level teacher or administrators if they came back that you're waiving the 30% on. So it maybe has a minimal impact for this 1 year. The only thing it does, it sets a precedent going forward that you might have to work back from. I mean, even though it's a 1 year period, it could set the fact that you've eliminated the penalty, which we've determined over the years from capers, it does barely, it may not even break even on the cost to them on a retiree coming back. So that'd be the one potential unintended consequence.
Representative Osmond.
Thank you, Mr. Chair. Just a point of clarification. So the motion was a substitute motion, which would then eliminate the motion that a substitute amendment, which would eliminate the amendment that we were previously dealing with. But your intention seems to be to add it into the amendment that we are currently dealing with, to add the 27.5.
So I think that's a good clarification, because as you said that, can my substitute motion be to move both balloon amendments simultaneously, which is what he may have been intending to do, or can I only move the one balloon?
Mr. Chairman, I believe you had the underlying, the first motion to do the 25 to 27, 27,500. And then there was then the substitute motion by Representative Schmidt to basically incorporate that same amendment plus what the 1 year sunset and the 1 year if they've been no penalty, no 30% penalty if they've been hired for 1 year. But it's really, you can either use that as a substitute motion, or you could, say that the original motion, if you wanted to include both of these, but it needs to be one or the other, I guess. It needs to be one motion.
But the substitute motion could be both of these bills. We could vote on the substitute motion. If it passes, we're there. If it fails, we are back on the original amendment.
We'll be back on the original motion.
Okay. So, and just to clarify, is that your intention that we would go with both of them initially? So, okay, thank you for that clarification. So, Representative Schmidt, did you have something that you had wanted to say?
I just want to propose that we incorporate both of these, and I think this would be significant enough to actually bring some people back from retirement. And I close.
Well, there may be a little more debate yet, but I wasn't sure if you had an additional point, so I'll give you a closing chance. My thought with it is 2593, we're making the change only for the school group, which would then apply a 1 year period to the school group that would, and 2639, we're applying it to the whole group. And for me with that, and if I end that on July of 23, is that correct?
Yes.
So with that, I like that idea, and the only thing that brought me off of that was the point that I can make in the case with this, 55,000 between July and the following July that I think captures a lot of the employees, and I don't know if I'm as willing to go through those hurdles to get that additional piece. So I'd probably go with the cleaner one, but I'm open to other discussion on the bill. Representative Riley?
Mr. Chair, I was not as prepared with this kind of discussion that it seems like the previous representatives were doing. So I probably will not be in favor of either one of these bills or substitute amendments until that amount goes to $100,000. Thank you.
Thank you. Further questions or discussion? Seeing none, Representative, you may close on your motion.
I close.
Oh, thank you. Motion seconded by Representative Neighbor. Thank you for catching me on that, staff. I appreciate it. And now, if there is no further discussion, you may close.
I close.
Heard the motion by Representative Schmidt to amend. All those in favor signify by saying aye.
Aye.
Opposed, no. Chair is in doubt. Those who are in favor, please raise your hand. Those opposed? Eight to 6. So on a vote of 8 to 6, the motion carries. So the amendment is passed on, which bill are we going to be using?
Mr. Chairman, I think since that motion included the 27.5, 2639 would probably be the cleaner of the two bills, but that is ultimately up to you and the.
So I would ask, since we had not clarified that we give the reviser discretion for other necessary technical amendments to that and to use that bill. But to that end, we've now passed an amendment and we would need to pass the bill. Am I right in our process at that point? And the bill that we would look to pass is 2639. Representative Neighbor.
Thank you, Mr. Chairman. I would move that we pass out favorably House Bill 2639 as amended.
Motion seconded by Representative Hoy. Discussion. Seeing Representative Schmidt.
Mr. Chairman, I think we should clarify then, the key points are that we are talking about all capers. We have raised the threshold to 27.5. We are doing a one-year sunset to 2023. And we are giving a one-year waiver on any penalty for someone who is retired, has been retired for one full year, is able to come back without penalty.
Yes, Mr. Chairman, I would like, so, to clarify on the motion, it's not just for the school group. I mean, your amendment was for the whole capers.
Could I also say, and thank the reviser, he has been through so many amendments. I appreciate it, and we need to give him time to finish it up when we're done here.
Okay. I think it answered, because I was anticipating the waiver penalty would only be for the school group, but it is for everyone. So now I truly can't support it.
Thank you. Representative Proctor.
Thank you, Mr. Chair. I'm holding on with both hands, trying to keep up with this rough and tumble here. So a employee who returns after being retired for 1 year will not have a penalty. Is that just for until the 1 year sunset concludes? Okay. Thank you, Mr. Chair. Huh?
Does that include an interim comment?
Further questions or discussion? Representative Hoy.
Thank you, Mr. Chair. The amendment did strike the changing the waiting period to 30 days, and I had planned to try to do a discussion on that, but I do feel that in the current state this bill is, that it makes a significant enough change with the appropriate sunset on it that I'm comfortable with it as it is, unless anyone else wants to go in that discussion, but regarding the waiting period, but I am supportive of where we are right now. Thank you.
Advisor.
Mr. Chairman, I just want to clarify with you and Representative Schmidt on the amendment. When we talk about the waiting period, I mean, the intent was to we're not changing the 60 to 180 under this. So they may need to make sure I have some clarifying language just to make sure it's still the 60 and 180 at age 62 as currently.
Thank you for the question. So further discussion. Representative Howe.
Thank you, Mr. Chairman. I had a question just as moving forward is I don't know if I can ask about intent of the carrier of the bill, but is the goal to just continue the discussion? I know we're coming up on deadlines, and is that kind of what we're seeking to do, is try to keep the discussion alive for this session so we can try to find a possible solution, whether or not that happens?
Thank you, Mr. Chair. I would just reiterate that since we're really in crisis mode, we're doing our best to say all hands on deck. And I do agree with the previous comments that were said that this is not enough to address long-term shortages. It's not going to be the biggest solution, but it does help to expand that workforce. And I don't know that I have any intent to do anything further to this. I believe that the will of this committee will be what's appropriate unless we hear things in between when this would come to the floor.
Mr. Chairman, if I could follow up on that. So it does give us a baseline. You had mentioned either it gets pulled above the line or at least allows the interim committee to continue work. Is that correct?
So the interim committee would be a separate request, but one thing that we could also pursue. So yeah, if it gets pulled above the line, that would be our next step to keep it in process.
Okay, I guess I'd just comment that in the spirit of trying to find a solution, I will support moving forward.
Further discussion? Seeing none, Representative Neighbor, you may close.
We have had a timely, wonderful discussion on this bill. I move my motion.
You've heard the motion by Representative Neighbor to pass House Bill 2639, favorable as amended. All those in favor signify by saying aye. Aye. Opposed, no? No. Ooh. The division on that by myself. Those in favor, please signify by raising your right hand. Opposed, same sign. Motion passes. Thank you. And the bill is passed. So, would like your vote recorded as a yes, Osmond, as a no, Riley. Any other votes to be recorded? Representative Schmidt recorded as a yes. And Representative Berquist as a no. Going once? Going twice. Thank you, committee, for your attention to that. Thank you, committee, for your work to this hour and your attention on the details. Thank you for the opportunity to serve as your chair. It is one that I will cherish. And Representative Croft.
Mr. Chair, just real quick, this is the last time we're going to meet, right? So I don't know about the rest of the committee members, but being your vice, I've really enjoyed the leadership and the mentorship you've given to all of us in this process. And we just want to, just tell you we're going to miss you on this committee. We're going to miss you in the House, but we know you got bigger and better things to do. So really proud to be part of that team. Thank you, sir.
Thank you so much. It is a great honor to work with each of you. I appreciate those words, and hopefully I'll get to stay underfoot somehow. So, Representative Neighbor.
Well, since I'm sitting to the right of you, as you're ranking, you've set a high level. I've learned a lot from you. And although sometimes I've looked at you or I've given you the evil eye, we have worked, I think, well together, and I appreciate your leadership, the quality of character that you have, and your attention to detail and follow through. So thank you very much for allowing me to sit in this position, and maybe I'll be on the left. No, that's not going to happen. Thank you, Mr. Chairman.
A sincere thank you. Thank you all. A wonderful night, and we're adjourned.